Okay. Hello, everyone. Can you hear me okay? Okay. I would like to welcome all of you, guests of Morgan Stanley, Kelliher Corbett Group, friends of Stonehill, alumni, faculty, administrators, and students. It is my distinct honor to open the second annual Market Insights Forum today. The first of these series was part of an inaugural celebration of the opening of the Meehan building in September of 2019, with the president of Federal Reserve Bank of Boston, Eric Rosengren, as our speaker. We were planning to do one of these events every year, once every year. But as you all know, COVID turned our lives upside down, and that didn't happen. So fast forward to last year. Thanks to our friends at Morgan Stanley and Kelliher Corbett Group, we plan to run one or two of these a year. Last year's event was on a Wednesday like today. It rained and poured, and we lost power on campus. Joe McLaughlin here, whom I will introduce to you more formally in a minute, and our Vice President for Advancement, Doug Smith, and I were on the phone beginning at 4:30 a.m. And I'm not a morning person, but I was up then at 4:30 a.m. trying to figure out what to do. By about 6 a.m., we decided to cancel the event and postponed it to today. Just to tell you what a hero Joe is here, his house was hit with a tree that came in and it sliced his house from the chimney to the rest of the house into two pieces with water gushing into his home. You know what he said? He says, as long as you have the power back, I will come in and we'll do this. So Joe, thank you for your loyalty and your dedication to Stonehill. We really appreciate it. So the decision to cancel that event was not a bad one in retrospect, because what happened was we lost power on our campus. We sent students, a lot of you know, we sent students home for a few days. We didn't get our power back till, I believe it was sometime on Friday evening. So since our last formal event, when Eric Rosengren of the Fed, Boston Fed, was here, a lot has happened in the US and globally. So let me highlight some of those, and those would be a segue for our speaker today, and then I move on and introduce my friend and former student Joe to introduce our speaker. So we are looking at inflation that is at a 40-year high. We are looking at a tight labor market with a really healthy consumer spending. Prices, because of those two things, go up. Add to it the supply restrictions and supply chain issues that we all are facing because of the pandemic, on top of what has happened because of the Russia invading Ukraine and the war. We are looking at interest rates having been raised by the Fed. This is federal funds rate, the short-term interest rate, but that determines so many other things. Inflation also influences interest rates. So we are looking at the Fed having raised since March of this year, having raised interest rates 5 times from what they were at 0.25%, quarter of 1%, I call it 25 basis points, to currently at 3.25. Next week, they meet on Tuesday and Wednesday. On Wednesday, by 2 p.m., they're going to announce what they will do with the rate. The markets are placing bets that the Fed, come next Wednesday, would raise the current 3.25 rate by 75 basis points to 4%. The next meeting and the last meeting of the Fed for this year is scheduled for December 14th, and the Fed is expected to, at that meeting, raise rates as little as 0.5% to as much as 0.75%. So based on that, we are looking at rates by the end of this year, beginning of the middle of December, be somewhere around 4.5 to 475 for this. So why? Because people in my field, I'm a money economist, don't know how to fix inflation without forcing a painful recession. And the way to do that is by raising interest rates, to make it harder for people to spend, to get rid of the aggregate demand part of this, but we can't really do much about the supply end of it, as I talked about earlier. So what are the odds of a likely recession? Well, Federal Reserve Bank of New York has a metric that calculates recession, the likelihood of the recession over the course of the next 12 months, or within 12 months. And early this month, that probability was 25.3%. This week, that has gone down to 23%. So maybe that's a good news. Maybe the soft landing that people talk about will happen. But Bloomberg last week did a survey, and their survey says 100% recession over the course of the next 12 months. So I leave that be, and we're hopefully going to get a lot of these questions covered and answered here. But let me talk about our friend and former student, Joe McLaughlin, a little bit, and then he will introduce our honored speaker. Joe earned his BA in economics from Stonehill. He was in my class, he was an English major, and he took economics, his principles of micro that a lot of you guys are taking with me this year, in his fall of his junior year, and decided to major in economics, and he wanted to drop his major in English, which was he was majoring on. And I said, you are an amazingly good writer, and you've had a good Catholic education, and I need you to I forbid you from dropping that major. So if you want to double major, you can. And I'm very proud that he kept both, and he did it. Joe has continued his education, and he earned a Chartered Retirement Plans Specialist designation, CRPS, a Plan Sponsor Retirement Professional designation, PRP, a Qualified Plan Financial Consultant designation, QPFC. Him and his firm have been named to Barron's 2022 Top 100 Institutional Consulting Teams. He has been named as one of the nation's most successful retirement plan advisors in Plan Sponsor magazine's annual survey every year since its inception in 2004. The Financial Times recognized Joe in 2017 and 2018 as one of America's top 401 retirement plan advisors. And he is a founding member of the National Retirement Advisor Council and has served in a leadership role for the National Association of Plan Advisors, NAPA. And that's what I expect from my students. That's just Joe lives in Lakeville, Massachusetts with his wife and 3 beautiful children. I'm blessed to have known them as they grew up, and they're all in college. He's a committed endurance athlete, completing multiple century distance cycling events, a half Ironman triathlon, and the Boston Marathon in 2016. He is a private pilot, as if he didn't have enough things to do, and now he's working on his instrument rating. It is my distinct honor and pleasure to introduce to all of you my friend and former student, Joe McLaughlin.
Thank you, Professor Kazemi, or Hossein, as I've known him for many years, and it has been exciting to watch our children grow up together. And I will say, obviously, very kind introduction. I appreciate you highlighting so many things. The reason I've been able to do all of that is because it's all easy compared to what I went through my senior year, working with him on that switch of major. Before I begin with a few important items about tonight's program, I want to thank everyone for attending. Certainly, the Morgan Stanley team. We have several members of the team here with us tonight. So, want to welcome the Stonehill community, the students, the faculty, the administrators, alumni, those of you that are joining us virtually, clients and friends of the Kelliher Corbett Group, of course. If you submitted questions in advance, we have collected all of those, and thank you for that. There were several dozen questions. As you might imagine, given everything that's going on in the global markets today, a lot of the questions had very common themes, so I broke them down into about 8 or 10 questions for Rob to tackle when he's done speaking. For those of you who want to submit questions during the presentation, whether you're here live or virtual, you can submit your questions to kellihercorbettgrp@ms.com. You should have received a little tag of paper as you were walking in. My colleague Jeff Fischer will gather all those questions and get them organized for Rob to answer. For those of you watching virtually, the cameras are disabled, so everyone's privacy is protected. Everyone's microphones are silent, so it's just our mics that are live for the event. And I want to again, thank the Stonehill community for giving us the opportunity to be part of this event. It's always a pleasure for me, given my friendship with Hossein, to come back and do whatever we can in service to the students to serve the Stonehill community. My team has been working with MFS for well over 25 years. If you're not familiar with them, Mass Financial Services, founded in Boston. They were the inventors of the mutual fund. They literally created the first mutual fund in existence back in the early 1930s, as I recall. And I've been to their offices many times. They have the original ledger of the first few dozen shareholders in the Massachusetts Investment Trust Mutual Fund, which is the legacy mutual fund that they created. Rob Almeida is their global investment strategist. If you watch the financial news on cable, you may be familiar with Rob's face. We have a lot of respect for Rob and his firm. We obviously have the opportunity to work with a wide array of different investment managers, different investment strategists, and we always like to bring the ones that we respect the most to speak to our clients. So this event is part of a quarterly event that we do for our clients, and we're doing this event in place of that, which is why we're also offering it via live stream. And Rob is definitely someone who we value his opinion, we value his views. He looks at the world very objectively, which we think is critically important, particularly in times like we've been living through this year. There's so much going on out there, and it's really important to filter through all the information, filter through all the noise, and really boil down to what matters, which to us is your investment strategy, if you're working with us as a client, and making sure that we're all working together to achieve your goals. We expect that markets will be volatile over time and that crazy events will happen and there will be disruption, but it's important to make sure that we're viewing that through the lens of objectivity. So definitely pleased to sponsor the event and have Rob with us. Again, he's the Chief Investment Strategist for Mass Financial Services. He's been with the firm since 1999. He's also a very interesting investment person to listen to because he has a wealth of experience on both the fixed income side or bond investing side of things, as well as the equity or stock investing side of things. So he's going to talk about what's going on, and there's obviously a lot of overlap with respect to those two markets. Rob grew up in the area in Raynham, Massachusetts, not far from where I've lived for the last 20 years. He is a graduate of the University of Massachusetts and earned a Master of Science degree in Finance from Sawyer Business School. And I think that you all will be very pleased to hear the wisdom that he will share with us today. And what we will do is, for those that submitted questions either prior to the presentation or during the presentation, we will collect all of those and we'll have some Q&A and we'll fire those questions off to Rob to answer for all of us. So with that said, Rob, welcome to Stonehill.
All right, thank you. Thank you very much. Good evening. Hello. Thank you, Morgan Stanley and Joe, for having me. Thank you, Stonehill. Most importantly, thank you all for coming. I think back to my university days, which unfortunately I feel old. It was over 3 decades ago. If I had the opportunity to attend an event like tonight, I was probably too lazy to do it. So I applaud you for just showing up and listening to what we have to say. So there's so much to talk about, and perhaps there's always so much to talk about because the future lacks facts. Right? There are no facts about the future. So it's always uncertain. And perhaps given what we're coming out of, meaning the pandemic, which was such a step function disruption to our lives. And everything that's happening with land war in Europe, what's happening with inflation and financial markets, perhaps it feels, and maybe perhaps it is, a lot more scarier than normal. But the more uncertain things become, the more cloudy, the more difficult, the harder it is, if you will, I think only increases the importance of simplifying things. So what I'm going to try to do here tonight in maybe just 15, 20 minutes, in my pseudo-prepared comments, and then through Q&A with Joe and with all of you, is just get to ultimately what matters, right? So what matters as it pertains to financial markets. So sociologists, or perhaps better stated maybe psychologists, refer to a common mistake that people make called observational bias, which is just a fancy word for, or term for, people confusing or conflating correlation with causality. Give you an example. So for those that maybe aren't from the area or didn't live here 9 years ago, I think it was 2013. I might have the year wrong, but I'm pretty sure it was 13. We got 3 major snowstorms in 3 weeks. I remember it specifically. The snow would start around Thursday, and it would end around Sunday. And this was pre-Zoom, pre-virtual, right? We weren't prepared for effectively a lockdown, if you will, like we had during the pandemic. But that's de facto sort of what happened. And I forget the exact cumulative amount of inches, but it was somewhere between 20 to 30 inches of snow that we got each consecutive week. And it was the 4th Saturday. So I was packing up my son's hockey bag. And my daughter, who's 2 years younger than Max, says to me, "What time's it going to start snowing?" Now, we were late, because we're always late, because my son would always forget something in a hockey bag. So I was really more just double checking it, because knowing something was missing. So I panicked, and I looked outside, looked out the window, blue sky, right? No chance of snow. I look at my daughter, and God, Sarah would have been, she turned 16 yesterday, so she would have been 7 at the time. I said, "What are you talking about?" She says, "Well, it's Saturday. It snows every Saturday," because that had been her experience for the last 3 weeks. And then there was no school on Monday. So Sarah was confusing Saturdays, the correlation of snowstorms, with cause and effect. And I guess what I'm driving at is, as it pertains to investing, whether you're investing in bonds, whether you're investing in equities, whether you're investing in publicly traded stocks or private assets or commercial real estate that's privately owned, it doesn't matter. The asset price of what you are investing in or what you own or what you're looking at, it's all a function of one thing. It's not a function of the economy. That might impact it. It's not a function of interest rates. That might impact it. It's not a function of who's in the White House. It's not a function of a land war in Europe. Those things might impact it. What matters is the profit and loss statement of the enterprise that you're investing in. It's cash flows. It's profits. Profits drive asset prices. Let me give you an example. From the end of the global financial crisis, which was a incredibly significant, deep, and painful recession, as well as very painful financial market performance. From the end of that, so the start of the new business cycle, right? So we had a business cycle that lasted 11 years. It went from 2009 until the pandemic hit. It was the longest business cycle that the United States has enjoyed since the Civil War. It was also the weakest. Economists refer to it as the Great Moderation. They use other terms like secular stagnation. Yet, The equity market was up 300%, the US equity market. The global equity market was up 250%. Non-US equities were up 200%. So what am I driving at? What I'm driving at is we tend to conflate things, maybe to make the complicated simple, maybe to make the hard easy, but we tend to, maybe as humans, lazily associate that one thing causes another. Maybe it's to make us feel better, maybe it's to make us understand something, and that leads to mistakes. It leads to financial mistakes as it pertains to your portfolio. Maybe you're unhappy with who's in the White House, or maybe you're unhappy with midterm elections, or maybe you're worried about a war, and it creates an investment mistake. So let me take a step back. So during that 11-year business cycle, economic growth in the United States averaged around 2%. Profits for companies in the S&P 500, so if you took the S&P 500, took all the companies inside it, and added up what their profits were, I mentioned earlier, they were up 300%. Stock prices follow profits. So if there's one thing I can leave you with here tonight, it's not interest rates, it's not GDP, it's not politics, it's not what a central banker said on TV last night, it's not something that Elon Musk tweeted, it's profits, 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 profits. The thing after that that matters, it's profits. Profits drive asset prices. So throughout the 2010s, the question that investors should have been asking or should have been questioning was, well, geez, the economy matters. The economy matters because it's a representation of spend. The economy is a representation of people spending money, government spending money, corporations spending money, people spending money. So surely that has an impact on companies' ability to generate profits. Of course it does. It matters. On average, revenues for companies, on average, it's usually 2 times economic growth, on average. So how do companies make money? Very, very simple. It's revenues minus costs. Really easy. Right? Think about your favorite coffee chain or your favorite music subscription service. How many people? What's the cost of the service or the product? Multiply the two, units times price is revenue, minus costs of running the business, equals profits. So throughout the 2009, what investors should have been asking was back to my point, well, if growth is nothing, if inflation is nothing, if central banks keep dropping interest rates to stimulate economic activity, why do profits and equity prices keep going higher? Well, what was happening in really, really overly simple terms, we have an incentive problem, I believe, in the United States. At least an incentive problem in corporate America, where many corporate chieftains are incentivized through their stock price. These are really smart men and women. What drives stock prices? The P&L. In a low-growth environment where you're selling fewer widgets, your investor base is expecting, demanding profits that look like last quarter or looked like last year. Volatility is nothing more than the market repricing for false assumptions. So if you get paid based upon the performance of your stock, and your stock's based upon the performance of the business, and the performance of the business is maybe subpar because the economy's subpar, well, what do you do about that? You pull other levers. You ship labor overseas where it's 20 times cheaper. You stretch your supply chains. And you borrow lots and lots of money because the cost of that borrowing keeps going down and down and down. But you don't invest it back into the business. You use it to finance higher dividend payments. You use that to buy back stock and use that to buy other companies to replace that growth that isn't there. And that happened throughout the 2010s. Then the pandemic hit. The pandemic hit, and businesses that were consumer-facing obviously saw their revenues go to zero. So very quickly, corporate profitability fell 30% in February, March of 2020. What did stock prices do? Fell 30%. So politicians, policymakers, central bankers said, okay, well, we can't allow a pandemic to create a crisis. We can't allow people to starve. We can't allow businesses to fail. So I'm not arguing against what they did. I'm just explaining what happened, and I'll bring that back to how it relates to today. So then what they did was they pushed rates even lower, created a dynamic where companies could borrow even more. Einstein once said, and I'm probably going to butcher the quote, but you can't solve a problem with the logic that created it. And so, to me, a recession, and I'm not an economist, but a recession is somewhat akin to washing your hands, right? So what do you do when your hands are dirty? You wash them. And what's happening, right? You're physically washing away excess. A recession is just it's the economy's way of rebalancing things that grew in excess. In the 90s, we built too many computers. We built too many fiber optics. We built too much technological hardware that the world didn't need. The recession of 2000 was painful for technology investors that owned equities of companies whose profit and loss statements could never meet expectations. That was a rebalance. Then in the 2000s, what happened? Well, we built too many homes. Americans were able to get loans that perhaps they shouldn't have, bought more homes, and the financial crisis was a rebalance of something that grew out of balance, which was we built way too many homes and we gave out way too many loans to people that we shouldn't have. Throughout the 2010s, what was out of balance? What was out of balance were interest rates were too low and companies were engineering what was the greatest profit cycle in this country's history. The pandemic gave the economy the opportunity to reset, but we didn't take it. So what central bankers did said, okay, we're going to have that reset at a later date. That's not going to happen now. So lower interest rates, let's put this time cash, instead of in a company's hands, let's put it directly into consumers' hands. Fast forward to today. So that's why we have inflation at 40-year highs, because we created too much aggregate demand. So what's happened in 2022 and why are asset prices lower? It's very, very simple. Every industry has a value proposition, right? So the medical industry has a value proposition. It's helping people from, it's healing people. The education industry has a clear, demonstrable value proposition. The technology industry, et cetera, et cetera. Financial services, similarly, has a clear and demonstrable and very important value proposition to society. What's our purpose, if you will? Our purpose is, 300-400 years ago, before capitalism existed, society's scarce resources, money, capital, was allocated by monarchs inefficiently. Capitalism is a little bit different. It's not governments allocating resources. It's you. It's people. It's Wall Street. It's the private markets. So what Wall Street does is it values a company, their cost of capital, the riskiness of the business is X or it's Y. So the purpose of financial services is really, really important in that regard. And what I'm really driving at is that purpose was taken from us during the pandemic. Financial markets price profits, right? The valuation of a stock or a bond is a reflection of the future profit-making ability of that asset. So as central banks were as lowering interest rates and using their balance sheet to buy assets, what they were doing effectively was disintermediating us, and it was pushing asset prices up artificially. So what you've seen in 2022, because inflation's at 8% and real people are struggling, having to make choices between meat and bread and milk and putting gas in their car and paying rent, this is the cost. This is the cost of years and years of overly cheap capital. Now all of that's reversing, right? So as the professor was highlighting, interest rates are going higher, and what this should begin to do is expose companies that should have failed many years ago. So now the natural selection process of markets, its true value proposition, should start to manifest. In other words, this company can't earn their cost of capital. So you have a lot of companies now who are borrowing capital at 8, 9, 10%. Their projects, or what they do, doesn't generate a 9 or 10% return. I won't mention the name of a company because it's local and it's private and I'm being recorded. But there's a company, so on average, companies' leverage ratio is around 1 to 2 times, so debt to profits. And what we call below investment grade or high yield companies, their leverage ratios are around 3 or 4 times. This particular company, and you would absolutely know it, is levered 12. It's unsustainable. So I realize I'm painting a negative, but hopefully realistic and honest, transparent picture for you here, but this is what I'm really excited about. What I'm really excited about is when something is abundant, it's not worth very much. When something is scarce, it's worth a lot. Give you an example, and this will resonate with everyone. So the pandemic, the lockdown, gave everyone on the planet economics 101 lesson or an inflation lesson. Toilet paper became incredibly scarce in March of 2000, and people were fighting over it. Now, they're not. If everyone could throw a football like, I don't know, pick your favorite football player, or dunk a basketball like Jason Tatum or Jaylen Brown, they wouldn't make 20, 30, whatever they make. They have scarcity value. And so as we look out over the next 2, 3, 5 to 10 years, here's what I expect as it pertains to investments in your portfolio. I expect your bond portfolio to behave materially better than it has. So yes, inflation's at 8%. Yes, central banks are going to keep raising interest rates. But ultimately, long-term interest rates, the 10-year Treasury, as a for instance, that's a function of cash flows. And the economy's not strong enough to handle where Fed funds needs to go. So in other words, I think Fed funds, short rates, will be higher than long rates like they are now. And that is going to continue to happen because businesses are going to fail. Unemployment will rise. We need to create economic stress and pain to rebalance what became imbalanced, which was you funded good companies and you funded a lot of bad, and it created too much aggregate demand. So I expect your bond portfolios to behave a lot better, because even though the central bank's going to raise rates, I think long rates are actually going to fall. I think they're too high. And one of the portfolios I manage, I've been buying pretty aggressively over the last several months, high quality, I won't say which, just for purpose of compliance, but let's call them investment grade, long duration bonds for the reasons I just mentioned. The equity portfolios, or the equity market, excuse me, I expect 2 things to happen. As companies start to report their profit and loss statements, not right now, but this quarter, next quarter, but really into 2023 and beyond, I think you're just going to see a lot of surprises. And investors don't like surprises. Companies might meet profit expectations, but they're going to guide lower. Companies' biggest expense is labor. That's 75% of their expense. Their second biggest expense is interest rates. Both those things are reversing from multi-decade lows. When you look back at pandemics over the last 1,000 years, which we did, something interesting comes out of all of them. Again, I'm not an economist, but during a pandemic, you deplete labor. During a war, which there was a lot of parallels, people were drawing a lot of similarities to war during the lockdown. You know, we're all in this together, we're all fighting a common enemy, so I get that. But from an economic standpoint, they couldn't be any more different. In a war, your shift away from making butter or economically producing things to making guns. And then, when the war's over, you shift back from making guns and ammunition and ships, et cetera, back to butter, like you had in the 1950s, and it creates very high rates of economic growth that last for a very, very long time. That's not what happens during a pandemic. What happens during a pandemic is people die. Priorities change. I went through this. I had aunt pass away, 50, my father's ill. Is this worth it? Yeah, I went through that phase. But I guess the larger point that I'm drawing at is we didn't deplete capital stock, right? We're not rebuilding buildings. We're not rebuilding things that we depleted during the pandemic. What we're trying to do is replace 2.5 million jobs that exited the labor market and said, I'm not coming back. So you've got a labor shortage that's consistent with all the pandemics over the last 1,000 years, combined with way too many companies that shouldn't exist in the first place, that's created way too much labor. All that needs to be rebalanced. And so for those companies that were selling a widget, generating a profit and loss statement, but the profit wasn't coming because they had a better widget. It was coming because they were shifting labor to China. It was coming because they were stretching supply chains. It was coming because they were polluting a river. I guess when I think about why the future is going to be a lot different for the better, it's because of technology. And I don't mean it because now you can get information instantaneously and watch funny videos of two cats wrestling on TikTok and those sorts of things. But technology, in really simple terms, made the world transparent. Bad things thrive in the shadows. They die when you shine a light on them. If you are a large apparel manufacturer and part of your excessive margin or P&L is because you had slave labor in your supply chain, that's over. The cost of compliance of emitting less carbon, behaving better, having a more diverse workforce, all that is expensive. All of that was part of the reason why companies were able to generate so much profit. They were generating profit at the expense of a stakeholder, at the expense of the labor, at the expense of the environment, at the expense of a more diverse world. All that's changing. And it's technology that's changing because it's made the world transparent. So now companies have to behave differently, better. They have to behave better, not just for their customers. Look at what's happening with, well, again, I'm not going to use a company name, but you all know who I'm talking about, a very popular entertainer who lost his contract with a very large apparel manufacturer. Maybe that wouldn't have happened 10, 20 years ago, but technology changes that. And all that's going to produce better economic growth, a healthier labor market, less pollution, all that's for the better, but there'll be some companies that can't survive in that kind of environment. They'll go away, and their asset prices will go to zero. And there's some companies that will. And what I'm really excited about is the scarcity value of those companies that weren't generating a P&L by doing the wrong things. They're going to be worth more because they'll be the scarce resource. And that's so different than the last 10, 12, 13 years. That's what I'm really excited about as an investor. So we stop there. Sit down, take questions, or stand here.
Where do you want to go?
I'll sit down.
Okay. Thank you, Rob, for sharing your views. Some of them a little bit dark, but we're we're in some interesting dark times. But I think that your final point is the one that's most important, that there's obviously tremendous opportunity that will be a byproduct of all of this disruption that we're experiencing. Again, dozens of questions came in. Thank you to everyone who submitted them. As I mentioned earlier, many of them around the same theme, so I tried to boil them down. Some of them a little bit more tactical, related to some of the topics that Rob talked about, so I'll start with those. Rob, how are you positioning your portfolios with the market that we are in, and what do you see in the future? I think you commented on that pretty well. Anything that you wanted to add?
Yeah, no, just maybe it's saying the same thing a little bit differently. For the last decade plus, the type of asset you own mattered. So if it was a growth company or a value company or large or small, I think that's going to matter less. And it'll be, is it a good business? And if it's a good business, it's going to be a good asset. And I think that's what's going to matter more. Bad companies won't be good assets.
Can you, if I can add my own
Yep.
question on top of that, can you expand upon that, where we've seen like such a rise in just the S&P 500 index versus the individual 500 companies that make up the index?
Yeah, so a lot of that is based upon how the index is constructed. And so this is going to sound like an anti-passive argument, and it is not. I think the passive industry has a tremendous value proposition because it simply created a price war. And lower prices are better for consumers, and lower prices are better for investors. But investing passively in an index is a very rear view, linear way to look at the world. So Joe's question is, you've seen the index grow dramatically over time for the reasons that I mentioned, profits up 300%, the S&P up 300%. Within that, you had a tremendous dispersion between very large companies generating large, outsized profits. And I guess what I would offer is what I think you're going to see, and you've seen this throughout time, right? In the 30s, AT&T was 12, 13% of the benchmark, and you have companies comparable size to that today. And I think what you're going to see as we progress over the 2020s is some of those larger names might not have the same type of P&L that they had over the last decade. And other companies in the S&P that you probably not even know of will have a better P&L. Let me maybe phrase it like this. You know, there was Web 1.0 in the 90s, right? And it was, go to CNN.com for information. Then there came Web 2.0, which is you can go to Amazon.com and then buy a pair of shoes. Web 3.0, which we're in the early transition of, is you isn't going to Amazon.com, you're putting on a pair of goggles and you're in a shopping mall trying on a dress or suit and tie. And the number of companies, or the percentage of companies that existed or exist today in Web 2.0, the bulk of them didn't exist in Web 1.0. And I guess what I'm trying to say is the same thing will happen in Web 3.0. So you always know who the innovators are in the world or in a room, because they're the ones lying down on the floor with an arrow in their back. Innovators get innovated out, and it's about the P&L or the commercialization of a science, not the science itself that matters.
Thank you. Where do you see the most opportunity in fixed income markets and in equity markets? I think you identified looking at the company level
Yep.
and sustainability of profits. So maybe a few more comments on the fixed income market.
Yep, so in fixed income, from an asset class standpoint, to me the most attractive is the municipal bond market. So when you think about fixed income, there's two simple risks, or I guess there's three. It's interest rate risk, it's credit risk, and then some combination of one and two. So treasuries, for example, it's all interest rate risk. There's no credit risk. And then you have, if you're going to lend money to my brother, who you don't know, you're not worried about interest rate risk. He's not going to pay you back. So that's all credit risk. And then everyone else is on the continuum, somewhere in between. And when we look at the municipal bond market, the default rate is like 0.000. It's super low. So some of the highest quality, highest credit-worthy issuers in the world. So that's more interest rate risk. So given my comments earlier, how I think long rates are anchored here, and actually I think will go lower, because they will go lower in a recession, and I think the recession odds are pretty high. I really like municipal bonds here, and also I just think directionally taxes are going up. I just don't see how they go lower.
Since you mentioned it, the next couple of questions were both around recession, so I think we can combine them. Talk about what the potential risks are for, I guess, a bad recession.
Yep.
Versus maybe the more optimistic side of how we could potentially hit this soft landing or at least have a mild recession.
So I think back to my opening comments about maybe observational bias and conflating. So there's a lot of people that do what I do, talking on television, talking about what Joe just asked, soft landing. Are we going to have a recession? And if we do, will it be soft landing? Will it be hard landing or something worse? And it matters. It matters. People get mad when I say it doesn't matter. It matters. But for your portfolio, I'm not sure if it matters as much as you think, right? So in other words, GDP is a flow, meaning it's just spend. So if you're looking at GDP quarter on quarter, or if it's year on year, it's just a flow. It's a representation of how much economic activity was in the economy during that period. 2/3 of that is consumer spending. The rest is companies spending money, government spending money, and the difference between imports and exports. So really, GDP is a reflection of population growth and consumer health. And as I mentioned earlier, a recession is just a rebalance of something that was out of balance. So what was out of balance in 2008? It was Americans with over-levered balance sheets and banks. That was corrected. So throughout the 2010s, it wasn't the US consumer that was leveraging their balance sheet. It wasn't banks, because regulation changed the way that they could lend money. They were really well behaved. So the consumer is actually in really good shape. Then combined with all this labor shortage and labor price, the consumer is fine. So I think probably the odds of a recession are high. I think the odds of a soft landing are probably pretty high, but I don't want to confuse that with that you can't have equity market pain, because again, when you're buying a company or you're buying the S&P 500, you're not buying GDP. You're buying the P&L. And the cost of labor is going up, cost of interest rates are going up, and growth is weak. That mix is a lower profitability than what you've had over the last several years.
Do you think that that's going to be a cyclical event, that in the coming cycle, profits will be lower than they have been in the last cycle?
Yeah, so usually what happens is you get a significant drop in profits during a recession, so I think that's coming. Then the larger question is, what's the terminal value for corporate profit margin? So just to put that probably confusing, nebulous statement into context, if you take all the companies in the S&P 500 over the last 100 years, and this is an unfair methodology because companies have come and gone and changed, and Ford's a very different business than it was 100 years ago, so this is just a blunt statement, but on average, profit margins are 7-8% in the US. What that means is how much of your revenue was retained as profit. So it's about 7% in the US, outside the US it's 5%. Throughout the 2010s, it went from 7 or 8 to 11 or 12. During the pandemic, it went to an all-time high of 13. Never seen levels like this, ever, literally ever. So recessionary margins are usually 4. So I don't know if we get there, but you're gonna have a cliff in margin. And then the question is, really to Joe's question is, what will be the new normal for margins? And I think given the necessary forced investment of companies having to invest in infrastructure to pollute less, companies have a more diverse and equitable labor force, all that's good, but it costs money. And who's going to pay for it? Either you pay for it through higher prices, higher price of bottled water, or the company pays for it through lower margin. So I think it's lower margin.
Thank you. One question that seemed to be a very common recurring theme, probably because of really the pain that retirees are experiencing currently with both high inflation and deflated asset values. What about those folks that have a shorter time horizon?
Yeah.
You know, they're in retirement, maybe, you know, we certainly hope that people are around as long as we can have them with us, but how do they sit patiently through an environment like this, given how it's this rare occurrence of fixed income asset values declining at the same time as equity asset values declining?
Yeah, that's a hard one. So you and I work in the same industry, but we have different functions. So I've never sat in your seat where Joe and Sally or two people or a person saying, hey, look, here's what I need over the next 15 years. Help me get there. And so that's a difficult question for me to answer because I don't have that experience. But I guess, but I kind of do because my parents are asking me that question. So I guess here's what I've told them. And that is, what do you need? Right, so let's clean sheet of paper. Forget what has happened. Don't focus on what has happened. Focus on what is it that you need. So what is your horizon? I'm going to live X amount of years. And you just run the math. I need, this is my annual expenditures are, this is what I have, et cetera. So to me, it should be investing based upon need, if you will. And I guess while I'm painting hopefully an optimistic picture for the high quality fixed income market, I realize I'm painting a negative picture for the equity market, but I don't want it to get lost, is that as bad companies go away and die, you think of every industry as a profit pool, right? So we call it a TAM, a total addressable market. There's a number of customers buying widgets, and the profit pool is split amongst all the companies in there. Really what I'm arguing is actually wildly bullish if you'll give it a little bit of time. So what I'm suggesting is a lot of the competitors go away, and that revenue will just accrue to those others. And so that will lead to, I think, a better P&L for that business than what you had. So for that investor, I'd say, how much do you need? Allocate accordingly, but don't conflate my bearish views that this is this doomsday scenario that's going to persist. It's going to be painful, and then it's going to be wildly accretive for those that are patient and can sit through it.
Thank you. Next question, again, compiling a few different thoughts that have similar themes to them. Talk about what your view is on why we've been seeing so much more volatility. Like you mentioned recency bias in your opening remarks,
Yep.
But clearly I think we're all reacting to that. So what do you think is causing that? Why does it seem that everything that we're experiencing is historic, right? This historic coalescence of a bad stock market and a bad bond market. And therefore, how reliable can we use history as a guide, right? Because in my seat, in dealing with our clients, we talk about using history as a guide, and things like election cycles and recessions and all that, like they all tend to behave similarly over time.
Yeah.
Yet, as we work through this difficult market, we're seeing things that we have not seen in a generation or ever.
Yeah. I think for the volatility, I think this is typical and symptomatic of late cycle behavior. So the way the market cycle works, just generally speaking, coming out of a recession, you have investors that are scared, and you have investors that got burnt, and investors that give up. My sister liquidated her 401k shortly coming out of 08. So you get a supply-demand imbalance, right? So there's not enough investors for the amount of supply, and prices adjust. They fall, super cheap. Then you get skilled, patient investors like you that step in and buy it. And then what happens? You start seeing tremendous double-digit returns. And that starts inviting investors back to the market. And then it reaches an equilibrium point where there's a balance, if you will. There's enough demand, there's enough supply in the market, and the market's fairly valued, but it never stays there. People want returns on their Bloomberg or on their Yahoo Finance screen or what they're seeing on TV but those returns are gone. So then what starts happening is you manufacture that return by using financial leverage. And then it gets to the point where we are now, where demand has exceeded supply. So I'll give you an example. Inflows into global equities in 2021 were greater than the last 20 years combined. So demand completely swamped supply, and that's why prices got so high. And to your question, I think you're seeing so much volatility because for that investor base that bought 6 months ago, they don't want to hear recession. They don't want to look at 20% lower because they know what's ahead of it. So it creates this volatile dynamic where I think maybe, I don't want to call them savvy, but maybe more rational investors are downshifting a little bit, and then you have others that are still piling in because they want to believe the narrative and believe the story. And that's pretty symptomatic of late cycle, and I think that's what's driving a lot of this volatility.
Jeff, any other questions come in that weren't similar to the themes that we've already addressed?
No.
Okay. So that concludes the formal part of our presentation with Rob Almeida as our speaker. If we would give Rob a round of applause for being generous with his time tonight. And again, before I turn it over to Professor Kazemi to wrap up the program tonight, just again want to thank the Stonehill community for the opportunity to be part of this program here at the college this evening. Thank you to everyone who attended virtually. It's been our pleasure to be here and support the program. So with that said, I'll turn it over to Professor Kazemi to wrap up.
Thank you, Joe. Thank you, Joe. Thank you, Rob, for a wonderful, wonderful event. Thank you all for coming. I want to once again thank Morgan Stanley, Kelliher, Corbett group, Jeff here, Ryan, just for your nonstop help and support over the course of the past couple of years to organize this event. I want to thank all of you for coming in for today and look forward to having these events, once or twice a year in the coming years. Thanks so much and have a great evening.